Good morning and welcome back to Almus Market Mornings. Bond markets opened June with fresh pressure. The 30-year US Treasury yields briefly touched 5% as investors weighed the impact of renewed tariff tensions and a softening manufacturing outlook. The ISM service showed a contraction in US factory activity for a third straight month, with slower deliveries and weakening demand reflecting the ongoing trade disruptions. In Japan, attention is back on the bond market ahead of the 10-year auction, following signs of a fragile demand in the recent weeks. And on the geopolitical front, talks between Russia and Ukraine resumed, though little progress was reported. Good morning, JK. I have a question for you. Despite the recent geopolitical events, dollar has not gone higher, but other safe haven assets like gold have gone higher. How are you reading that?
Good morning, Suraj. Yeah, I think it's almost getting a consensus view that dollar has lost its safe haven status. Uh, Two reasons I could say that keeping more and more dollars is not helping the investors because there's so much of uncertainty on the policy front as far as US is concerned, and secondly, market, or I would say the global investors, including the central governments or central banks of other countries, have invested substantially in the US, and there is a risk. There are several risks, in fact. One, economy could slide, and secondly, the bond market turmoil could intensify because no clear solution is visible for their high deficit and high debt. And at some point, the bond market, the prices could just slump, taking the yields higher. So that's the reason why people are not putting money into the US. And let me also, point out to the latest, focus of the market. While the that budget bill has been passed through the House and is going into the Senate, it contains a very important provision of Section 899, which says that there could be a tax load of up to 20% on the passive income of foreign investors, such as dividend for or royalty payments, and this could be another big stop point for the foreign investors to put fresh money into US. This is not. This is coming at a time when US actually needs increased foreign outflows for funding their debt and deficit, and it's also not coming at a time when actually the S&P is underperforming the global stocks by as much as 12%, and this is happening after several years. And in fact, out of the last 7 years, it had outperformed, and an underperformance by S&P is also not helping. So both bond market and equities are not really luring the investors into the US market for both the performance as well as the challenges of the policy. And of course, the repatriation tax will be one of the biggest hits if it does happen. One does only hope that this is another tactic used by the Trump administration to get the other countries who are subjected to tariff to come to negotiating table and offer better terms to the US. This is a positive thing that we can have in mind, but we really do not know what's coming up next because there are so many developments that we have pointed to already. Higher tariffs on steel and aluminum, possible 15% tariff on all countries for 150 days. They're also pointing to China breaking the Geneva agreements and all that. China is denying it. China and Europe are trying to retaliate against the fresh tariffs on steel and aluminum. So it's a whole muddle, and I think this is the background in which US dollar is not going to be bought when there is some tension anywhere. And in fact, you talked about geopolitics and the talks going on. Yes, I think there are again a contradicting picture. The US and also the Turkey president claims that the talks are going on, but even as that is said, the bombings from both the countries are also going on. So what is the eventual outcome? Market is not very clear. And in this circumstance, I think when US is not really able to influence fully the ceasefire between Russia and Ukraine, I think market is not really interested in no, putting more exposure to the US, and they are in fact in search of alternative investments. Emerging markets have actually really well performed in the last few months. Also, there are ongoing talks in Europe how they could, have a consensus on floating a common European bond, and that could, allow a lot of money to flow into Europe, which they could use for their, further infrastructure and defense, as well as the, various deficit, which is stopping them from spending for development. So that is what the market is positioned now for. They are looking for avenues other than the US dollar for all the reasons that I have stated. Yesterday, of course, the gold was the immediate target for selling the dollar and buying gold. In fact, other metals like silver also rallied along with the gold. Dollar, of course, did not make a new low against the euro. It was stopped at 1.1450. But important to see that the base is also slightly rising, and now even a foray below 1.13 is also proving to be very temporary. And we have a whole host of data this week, and the central bank meetings. ECB is meeting, Canada, and then RBI. We have the policy decisions by these central banks. ECB expected to cut, Canada likely to hold, and India, of course, there are rumors that it could be a hefty rate cut of 50 basis points. We'll come to that later. And US will have a host of job market related data. And there is a sense that, today's JOLTS data, which is going to show the job openings number at the lowest level since January 2021, to eventually reflect the market's fears that the tariffs and other policy challenges are starting to impact the job market. So, of course, we'll have more indications as we move into in the week. But that's the reason why market is not buying into dollars, despite indications of any geopolitical problems or other risk of type of scenarios. Manufacturing surveys yesterday again presented a mixed picture. Europe was steady, while in UK there were, the final number on S&P survey showed, a slightly better picture. But though the sector is still facing challenges. US ISM surveys showed, slightly lower compared to the previous month. Challenges of new orders continuing to contract, prices being higher. Again, these numbers are hard. These are surveys, but the hard numbers so far also have not been so encouraging. Yes, economy has not slumped as much as people thought, and it is still to raise major concerns even among the Fed members, who continue to adopt a wait and watch attitude. But I think it's still on a watch, and it can suddenly, you probably will see a situation where suddenly data slumps because the cumulative effect of all the things that are going on, of course. On the rupee front, of course, yesterday with the month end over, the repatriation pressure was less, and even the dollar index was weaker, so that would have seen the rupee even more stronger than actually we saw. But it was also counterbalanced by FI outflows seen after quite some time, and then PSO banks reportedly buying and probably covering for government outflows. Now back to RBI, the rate cut of, jumbo rate cut of 50 basis points being suggested by some of the well-known research houses in India, and this is just to spur, invigorate the credit cycle and counterbalance the global uncertainties. Yes, we did have a good number on GDP, but perhaps I think there there are signs that economy could struggle, particularly on the trade front and manufacturing, if the tariffs become a bigger, tariffs are higher. Therefore, these could be a preemptive move, but I personally do not support a 50 basis point move. I think a measured move by 25 basis points, and wait and watch the price pressure or the price developments on inflation, which could, nothing wrong. Even if 25 basis points spaced out between two meetings is also good enough for the market. So I think that is what I prefer. But yes, sometimes you can always get a surprise from the central bank. But what I would be interested to watch is whether the uh, uh, rate cut of 1% total from the in this cycle so far in a short period of time is going to put some pressure on the INR. Whether the lower differential, not only with the US but with other nations also, could see some lesser interest in INR. Assets or fixed income compared to others. So that is something that we will have to wait and see. Although the growth picture still argues for India to attract more capital. Week full of lot of central bank activities and also data. So I think dollar remains in a range, but we should wait for some more time for breakout, even as the tariff saga continues. Thank you.
Thank you, JK. And I think the broad theme remains that investors are searching for other avenues to put in money. US is not getting that safe haven bid, which US dollar is not getting the safe haven bid it used to. This is despite the geopolitical events that has been going on. And on that front, though the US and Turkey claim there are talks ongoing, the bombing continues at the respective countries. When it comes to the data, we have the JOLTS data from the US today, which is expected to show very low job openings. That would be a cause of concern. And on yesterday's manufacturing PMI numbers, it was steady from Eurozone and UK, though US showed a dip. Interestingly, one thing to keep in mind, which JK mentioned, was that economy has not slumped. The US economy has not slumped as much as people had thought. It remains relative to expectations. It remains somewhat steady. When it comes to rupee, we traded stronger against the dollar as dollar index remains slightly weaker, but largely it remains range bound. There are now suggestions of RBI expected to cut rates by 50 basis point in the next meeting to provide a boost to the economy. We'll see how that plays out, and we'll dive deeper closer to the rate decision. That's it from us today. Thanks for listening. Have a great day. We'll catch up tomorrow with a fresh round of updates.